a managing partner at Grant and Noble, and also we also have CPA Veronica, who will be speaking to us this morning. I still count now, we have about 331 members on this webinar this morning. I want to encourage you to go on and tell someone about this webinar. Someone might have forgotten, they might have registered but have not yet joined in. Just send them a WhatsApp, send them a text so they can tune in and do not miss out on this webinar this morning. Once again, I welcome you. Thank you for making it a point to attend this webinar. I know some of us are working at home, others are in office, but have set time apart to attend this webinar. Thank you so much for your time. The learning outcomes today are so many. You're going to be able to learn new things. Learning never stops. You might know about taxation of business income, but I'm sure at the end of the day, you'll have learned something. Your time will not go to waste. Without wasting more time, I'll go on to introduce to you the first panelist that will be speaking to us. I say this is CPA Abed Tindiewa. I'll go ahead and summarize for you his profile. He has a bachelor's degree in economics from Makerere University, a fellow of the Association of Chartered Certified Accountants, member of Certified Public Accountants of Uganda. His working experience is rich. He has consolidated the working experience of 23 years with 17 in consulting. He's currently a principal and lecturer of taxation at Grant and Noble Business School. He's also currently a managing partner at Grant and Noble Certified Public Accountants. He has worked with Ernst & Young as a senior tax consultant, worked with the Uganda Revenue Authority for 5 years. He has also previously served on the following ICPAU committees: member of Planning and Development Committee, Education Committee, Marketing Committee, and also chairperson, Taxation and Economy Subcommittee. With this rich experience, I'm sure that at the end of his presentation, we will all be able, we will have learned something from him. You're welcome, CPA Abed, to present to the members present this morning. Thank you.
Hello, Chair.
Yes.
Can we start with Veronica, then Abed will come in.
Okay, thank you for the notification. I'll proceed to introduce to you the other presenter, who is Veronica. I'll go through her profile briefly. Veronica Magembe is a tax manager at PricewaterhouseCoopers. She has worked with PwC Uganda for over 9 years, providing numerous tax compliance and advisory services to companies. She also worked with PricewaterhouseCoopers in Ghana for 2 years. She is a member of the Association of Chartered Certified Accountants, that is ACCA, and also a member of the Advanced Diploma in International Taxation under the Chartered Institute of Taxation in UK. Together with me, let's welcome Veronica to speak to us this morning. I hope you have a pen and paper, and also I encourage you to write down your questions, and we'll have the panelists answer them at the end of the presentations. Veronica, over to you.
Thank you, Chairperson, for the brief introduction. I'm going to share my presentation for today.
Veronica, kindly switch on your video so that the participants are able to view you.
Okay. Thank you, Madam Chairperson, for the introduction. I'm called Veronica Magembe, as I've been introduced, and I'll talk about taxation of business income. URA has a target for FY 2021 of 20.2 trillion Ugandan shillings, and from collection of tax revenue. So URA has brought and enrolled various tax measures to ensure that they're in position to meet this target that's set for the next financial year. So it's important for businesses to ensure that their declarations are correct and the business income declared is correct. So on this basis, I'll go into my presentation. Yeah, so this is the agenda for today. I'll first talk about what is this taxable income. And taxable or chargeable income is made up of your gross income less allowable deductions. So what's made up of gross income? This will be, it's made up of employment income, business income, and property income. So my co-presenter will discuss this in full, and my presentation will concentrate on what's allowable and non-allowable deductions for tax purposes in arriving at taxable income. So there are specific rules that apply on deductibility of expenses. And I've categorized this into three. We have the general rule, which looks at expenses incurred, whether they are incurred in generating business income. So the general rule is that such expenses should be allowable. However, there are specific rules that disallow specific expenses for tax purposes. We'll also go through those kind of expenses. Then we also have expenses that arise due to timing differences, such as provisions and then capital allowances. So I'll discuss each of these. So for the specific deductible expenses, these ones are specifically set in law, and one of them is the minor capital equipment. So a company recognizes capital expenses in their profit and loss account, so the tax law will allow 100% deduction if the cost of that expense is less than 1 million and it can function on its own. So URA allows a deduction 100% for such capital expenses. However, for other capital deductions, URA allows those ones, and I'll discuss in detail the nature of those deductions. However, the depreciation, which is recognized in the P&L by the company, is added back for tax purposes. Then we'll have rules on interest, which I'll also discuss in detail. We also have repairs expenses incurred by a company to repair any form of property, as long as that property is used by a company in generating income, such expenses are allowable for tax purposes. We also have bad debts write-off, and these ones are also allowable, but the key is to have documentation in place to support the various write-offs. And we've seen URA requesting for documentation to support what has the company done to support that it has tried and done everything possible, but it has failed to collect. So some of that documentation required in practice, though it's not specifically listed, you may have to show that different letters showing that you followed up, evidence of board approval for that write-off, as well as if there is any legal action taken, legal procedures, evidence of that documentation showing that there's some legal procedures taken. And for some cases, you may find that some companies have liquidated. So if you can show proof of the various documentation that the company has, then that bad debt write-off should be allowed as a deductible expense. Then we've also seen a couple of companies have tax losses carried forward from prior years. So those tax losses form part of the deductible amount before arriving at the taxable expenses. I'll talk about the key expenses that are allowable. One of them is interest. So generally, interest expense arising from a debt obligation is allowed as a deductible expense as long as it's not more than 30% of your EBITDA. And that's the tax EBITDA. So any interest which exceeds 30% of your EBITDA can be carried forward to the subsequent years for the next 3 years. So it has a restriction of 3 years. But in some cases, we've also seen interest which is deferred. So such interest the general rule is that deferred interest should be recognized on accrual basis. But when it's paid, then that interest is taken to be derived and a deduction can be allowed. And we have a case between ATC and URA where this has been ruled upon. And also, we have, I've listed some specific expenses which are not deductible for tax purposes. And some of them private and domestic expenses. Any expenditure, any capital expenditure is also not allowable. Penalties and losses that are imposed by URA. Life insurance, we have a couple of companies who provide life insurance for employees. So that insurance is not deductible for tax purposes. Then expenditures, which are more than 5 million that are incurred in one transaction. Such expenditures are not allowable where the supplier does not have a tax identification number. Then also gifts should also not be deductible. On the other hand, we have other expenses. We have entertainment, meals and refreshments. So entertainment is only allowable where it relates to, it's included as part of the employee's employment income. That's if that entertainment is a cost as a result of staff cost. And also companies give meals to staff. So if a company gives meals to staff, to all staff, whether the company premises, as long as it's on an equal basis, then such meals will be deductible for tax purposes. As also entertainment, which is entertainment expense incurred while undertaking business duties or business travels, that one should be allowed. But any form of entertainment for personal benefit should not be allowed. And there is a narrow link between such type of entertainment, but companies should try to separate between entertainment, which is incurred for business purposes, which is allowable, and that one which is not. We have donations, and generally the law allows a deduction for donations made to exempt organizations. So the exemption is not, because we have institutions that are listed as exempt organizations, such as sporting, religious, as long as they are charitable, but that is not enough. These institutions should have an exemption certificate from URA. So if a company makes a donation to an institution, you're required to ask for that exemption certificate, even if it's not even if it's a non-for-profit organization. And the amount of donation is limited to 5% of your chargeable income. There is a new proposal, donations which are being made to government for treatment or for prevention during the COVID pandemic. Those ones are being exempted in the proposed amendments. Then we have the expenses which arise as a result of timing differences. So generally, such expenditures should be deductible as long as they qualify to be deemed as a payable. And there's a criteria which we follow to determine if such expenses qualify to be a payable. And the key condition is economic performance. So if you receive a service, has that service been provided? Or if the expense is in relation to a property, has that property been used for that period? And if in any other case have you received payment, yeah? Then you should be in position to establish the amount of that expense and for all events to have occurred. So generally, if a company creates a provision and that provision, the expense will be accrued in future, then it's not deductible in the current year until when it's been incurred. Then we also have specific rules around foreign exchange losses. And the foreign exchange losses are only deductible once they are realized. So any losses which are unrealized, they may arise out of differences in foreign translations, and the debtors have not yet been paid or received. So such losses are unrealized until when the debt is settled, and those ones are non-deductible for tax purposes. We also have prepayments. So if a prepayment extends for a period of more than 13 months, the requirement is that the deduction should be applied over the duration of that period. Yeah, otherwise, if it's within a 12-month period, then you can have that deduction for that year. And that's on a matching principle for accounting purposes. I'll talk about the deductions for capital costs. So generally, the tax law provides for deductions for capital costs, which is different from depreciation, which is computed by the auditors. So for tax purposes, we'll add back that depreciation and allow capital costs based on the tax law. So the different capital costs and allowances that we have, one is the initial allowance. So initial allowance applies to assets, and these are eligible properties that is put into service for the first time, as long as that asset is located with outside a 50-kilometer radius from Kampala. So the key here is that the eligible property includes mainly plant and machinery, but there are some exclusions for passenger and commercial motor vehicles, furnitures and fixtures, as well as items of ordinary used for household purposes. So the challenge with this is in determining where do you draw the line for the 50-kilometer radius, and where does Kampala start or end? And we've also seen challenges where you have an asset that starts from within the 50-kilometer radius and ends after the 50-kilometer radius. So does a company have to apportion? So it depends on the nature of the asset in this case. So you have to look at where is the main part of that asset located, and as well as if the feasibility of apportioning that allowances between what qualifies for initial allowance and what doesn't. Then we have capital allowances that this is wear and tear, and granted it relates to depreciable assets that are granted capital allowances, and the rates vary from 40% to 20. And we have those rates prescribed in the tax law. So the other allowance is the industrial building allowance. This is a 5% allowance. It's also given to industrial buildings as well as approved commercial buildings. There is also, if you have an industrial building, a qualifying industrial building that has been put to use for the first time, there is a 20% initial allowance that is granted to that building in the first year. Then there's also a deduction for intangible assets, and this spans over the useful life of the asset. And then lastly, we have some deductions allowed for startup costs. And startup costs are mainly pre-incorporation costs that are non-recurring, and they're mainly incurred by a company that's starting over business, and this may include legal costs and various advisory costs for a company to start up. And these costs are granted a 25% deduction over, those are over 4 years. I'll just talk about the common risk issues identified when accounting for business income. So the key one we've seen is lack of documentation to support the transactions. Because if you're going to get a deduction for expenses, you need to have documentation to support that a company has incurred such expenses. And we've found that this documentation is lacking in some cases, yet the transaction should have been allowable. Then incomplete completion of the tax return template. This is key because URA has visibility in terms of the company's declaration using the tax return. So the declaration you make is key for URA to determine or to have visibility in terms of the transactions conducted by the company. So this implies that the different schedules should be completed correctly and different kinds of expenses in the return. We've also had issues of misclassification of capital assets and costs, whereby, and I'll give an example of motorcycles. whether to classify them, whether they qualify as motor vehicles or not. We also have printers and iPhones, because those ones these days they use data. So if you have an iPhone or a printer that uses data, the issue of whether you classify it under class 1 or 4 is also key. Then expenditures that are above 5 million incurred from suppliers without TINs is also key in ensuring whether those expenses are allowable, as well as bad debts write-off. So once you've determined your expenses that are allowable and are disallowable, then we go into how do you now compute your taxable income. So this is just a summary of how your computation will look like. So we'll start from the profit before tax that is derived for accounting purposes. Then we adjust those expenses that are not allowable, and these expenses form part of the P&L. And those ones that are allowable, then there are also adjustments for income. So we have deferred income, and this income is as a result of the timing difference, which we add back, but will be taxed once it's receivable. Then we also have some non-taxable income, which is more or less final income. And an example is interest income on government securities. So then you arrive at your taxable income, you apply a corporation tax rate of 30%, then allow any tax paid during the year. So the tax credit which is allowed, the withholding tax credit, it's not all form of withholding tax that's allowed. It's mainly withholding tax, that's advance tax, but we have final taxes such as interest income, withholding tax imposed on interest income on government securities, withholding tax on commission for airtime. So where withholding tax is a final tax, it does not form part of your tax credit for tax purposes, then you can arrive at your net tax payable to URA. I'll talk about the recent issues that are related to income. So given the economic turbulence that we are in, as well as the pandemic and how it has affected the economy, the government is also under a lot of pressure to raise as much revenue so that it meets its target. So one of the proposals that have come through is the introduction of the 0.5% tax on turnover, and this applies to companies that have no tax payable or that are in a tax loss position. So this proposal has appeared in the tax bills for the last 3 years, and it also forms part of the current tax bills, but we hope that it doesn't go through, because this tax is directly on turnover, which is different from how we determine chargeable income as discussed above, because tax should be charged on your net income after deducting expenses. There are also various tax measures that are being enrolled by URA, and one of them is the withholding tax exemption. So withholding tax, all companies that are designated withholding tax agents that make payment for goods or services to companies, and that amount is more than 1 million in aggregate, are required to withhold tax unless if that person is exempt from withholding tax. So now this withholding tax exemption is key, so that it frees the company's cash flow so that the company does not suffer that 6% withholding tax at the point of receipt of payment. And it's key for companies to be included on this withholding tax exemption so that when a company imports goods, those goods are not subject to withholding tax, and also they are able to receive 100% cash to run their business operations, as opposed to getting an offset at the end of the year. So the key change is that this withholding tax exemption is now automated and is online. And prior to this, that will begin from FY 2020, 1st July 2020. But prior to this, companies were required to apply for withholding tax exemption manually, and there would be a list of taxpayers who are exempt from withholding tax, and that list was published every 6 months in a year. So now with this new change, that withholding tax exemption will run for a period of 1 year. But this does not mean that inclusion on that list is automatic. If within the 1 year URA finds that a company is not compliant with their tax obligations, or there is any issue of fraud, then URA has the right to revoke that withholding tax exemption. And URA has gave a 30 days deadline for registration. It started from 25th of May 2020, and the deadline for applying for this online withholding tax exemption expires, which is tomorrow, the 25th of June. So it's key that you all enroll for this before the expiry of the exemption tomorrow. I'll also talk about the withholding VAT exemption. So all URA amended the tax law last year, and all taxpayers who are designated withholding tax VAT agents, they are required to withhold 60% of the VAT unless if the taxpayer is exempt from VAT. Yeah. So URA is planning to issue the Gazette next financial year, in July next year. So this provision has been in the law since last year, but it's not operational. But once URA issues the Gazette of withholding tax agents for VAT, then it will become operational. And also, as part of the application for the withholding tax exemption, taxpayers are also required to apply for this VAT withholding exemption, and also the application is due tomorrow. So the criteria for being on both the withholding tax exemption for income and VAT are set out below. So one of them is to ensure that the returns are filed properly for both entity and directors. So in practice, we've seen URA checking directors' records for both resident and non-resident to confirm that both of them have TINs. And now for non-resident directors, for them to have a TIN, they need to have a work permit. Otherwise, they have to do a power of attorney and nominate a representative in Uganda. Then also you have to be compliant with all your tax payments, no tax planning schemes that are aggressive. And also we have new measures. You have to be in compliant with your digital tax stamps, as well as the electronic fiscal reporting and invoicing system. So I'll talk about that one in detail below. Also, you need to tick and show who is your tax agent. And also for companies that do clearing, you need to have clearing agents. The other initiative that's being rolled by URA is the e-invoicing. This is a solution that's being introduced by government, mainly to manage domestic, as a strategy for collecting revenue and also to digitize the tax system. So this solution ideally manages issuance of receipts and invoices for tax purposes. And where URA has introduced this scheme is mainly to improve or to reduce on under declaration of sales, help with record keeping. We've seen cases where URA does an audit and the company doesn't have audits. So URA will have this record since they have the information in real time. Then also refunds, it will speed up on the refund process because URA has the real-time information. So this system, URA has been facing challenges where companies request for refunds and offsets which are not authentic. So this system, how it will work, URA will, there are two options that that more or less to be implemented first. One, a company may have its system, so URA can link its system to the company's system so that whenever a company issues invoices for sales, URA gets that information in real time, and also the expenses, the invoices received in respect to expenses, URA has that information in real time. Then also, in terms of the implementation, URA has started, or they started reaching out to different companies. They've done a pilot of more than 60 companies now, where they are training them on how the system will be run. And those trainings are ongoing, but clients are required to start operationalizing this system effective 1st July 2020. But URA will give, since it's a new system, it will give a grace period of 3 months to allow taxpayers get as much information regarding challenges that are being faced. So effective at least 1st October, URA expects that most taxpayers should be in position to have run the system effectively. So the other form of system is the manual one. So if a company doesn't have a system to engage with the URA system, you can opt to do a manual one where a company can raise invoices through the URA portal. So right now, all businesses are required to register with URA for e-invoicing. And this is one of the criteria that URA will use before granting you a withholding tax exemption. So in terms of how do we treat such expenses as a result of this new e-invoicing system? So for expenses where you purchase an expense or where you purchase a good or a service from a supplier who is designated to be on the e-invoicing system, and you don't have that e-invoice, then such expenses will not be allowed for tax purposes. So you need that e-invoicing for you to get a deduction for the expenses. Then it will also affect input VAT in such a way that for a company to claim input VAT, you need to have that e-invoice from your supplier. So these are key initiatives that are being introduced by government, and this system was rolled out by other East African countries, and it's running. So it's Uganda that has been running behind, and they hope to implement this come 1st July 2020. So in summary, I've come to the end of the presentation, and these are just the key takeaways from the presentation. And one of them is to automate, the automation of the withholding tax exemption, as well as the withholding VAT exemption. And these are due for application by 25th June, which is tomorrow. Also, all companies are required to register for e-invoicing. And also this is key in allowing a deduction for the expenditures incurred for suppliers that are on that e-invoice platform. Then also input VAT, you will need the e-invoices. Generally, expenses which are deductible and are incurred for business purposes should be deductible. Also to take note of expenses that are more than 5 million that are made in one transaction. So you need a TIN from such suppliers for them to be allowable. We also have restrictions on deductibility of interest to 30% of EBITDA, as well as the allowable capital deductions, and then the documentation required for the bad debt write-off. This marks the end of my presentation, and thank you very much.
Thank you, Veronica, for the wonderful presentation. Reading from the chats, I've realized that people are really following and the presentation was good. We'll proceed to the next presenter, who is Mr. Abed, but before that, I forgot to introduce myself at the beginning. I'm CPA Nandera Mitchell. I work with Minet Limited. We are insurance brokers, and our offices are located at Clement Hill Road. For all your insurance needs, you can pass by and you get help. We'll proceed to hear from CPA Abed, but I also encourage the participants to continue sending in your questions. They'll be answered. Continue chatting with us. We need to know what you're thinking, what you think about the presentations, about the presenters, and all your questions will be answered and considerations will be taken for whatever information you send in. I'll introduce CPA Abed again for those that were not on by the time I first introduced him. Right now I can see we have 700 participants attending this webinar. Thank you for the attendance. We're very happy. And also I'll still encourage you to tell someone to listen in either on Facebook or come and also attend the webinar that is going on right now. I'll go on and introduce CPA Abed again before he goes on to present. CPA Abed I'll start with his education background. He holds a bachelor's degree in economics from Makerere University. He's a fellow of the Association of Chartered Certified Accountants, a member of the Certified Public Accountants of Uganda. His working experience is rich, as I had said earlier. He has a consolidated working experience of 23 years, with 18 in consulting. He is currently a principal and lecturer of taxation at Grand and Noble Business School, currently managing partner at Grand and Noble Certified Public Accountants. He has worked with Ernst & Young as a senior tax consultant, worked with Uganda Revenue Authority for 5 years, and also previously served at the following ICPAU committees: a member at the Planning and Development Committee, Education Committee, Marketing Committee, and the chairperson, Taxation and Economy Subcommittee. With this vast experience, I'm sure after his presentation, you will have learned a lot. I request you to note down your questions, as I had said, and they will be answered. Over to you, CPA Abed, to proceed with your presentation. Thank you.
Thank you, Chair, and thank you, participants, and my co-presenter, Veronica. She had a good presentation. I will straight away move to the summary of my presentation so that we can look at what I have. Peter, can you move a bit? My presentation will have introduction and definitions. It will look at compliance issues. It will look at the recent changes, including COVID-19 tax reliefs and the question and answer session. In the introduction, we are going to look at what is business income, which is subject to income tax. The law says that any income derived by a person in carrying on a business, including the following items, is part of business income. Gains and losses on disposal of assets. That if a business disposes of an asset which is non-depreciable, like land, like shares, that would give capital gains which become part of business income. But also when it disposes of a depreciable asset, especially where the assets in the class have been all disposed of, and there is a balancing allowance, also that becomes part of business income. Then there is gross proceeds from sale of stock. If it is a business that deals in merchandise, the money you realize from sale of stock is part of business income. There is interest income from lending business. Interest income for financial institutions, other lending institutions is part of business income. But the one which is not from that source, like the one on fixed deposit account, the one on savings account, that is property income. It is not covered under business income. Any value of gifts, whenever you get a gift that arises from your business relationship, whatever form it is part of business income. And if you receive any consideration for restricting a person's your capacity to carry on business, it is also part of business income. So business income is a lot inclusive. Many items will come under business income, but we have to appreciate that one, rental income is not part of business income. That one is taxed separately under rental tax. And as I've said, we have income that mainly comes from investment, interest income, royalties, etc. That is property income. It is not business income. Much as it becomes part of gross income of a taxpayer, but when determining it, we use different rules, and our discussion is mainly concentrating on business income. We have to appreciate that when we are looking at business income, we need to know what is a business. A business is defined like as if you are carrying on a profession, a vocation, if you are carrying on a trade, selling and buying, or any adventure in the nature of trade. I think the last part is what really brings in a lot of complications, because we are saying that whenever you engage into a venture where your intention is to make a profit, then it is part of business income. Then we need to know which persons are liable to tax on business income. The law defines a person to include an individual to include an individual, a partnership, a trust, a retirement fund, a company, and government body. So the tax on business income applies like this. If you are an individual with business income, it is taxed either under presumptive or small business taxpayer regime. And also you can choose to use a self-assessment regime. Almost what Veronica has explained, you go through getting your income, computing your allowable deductions, and you file a complete return. So as an individual with business income, if your turnover is less than 100, annual gross turnover is less than 150 million, you can choose to go under presumptive tax. And I will be elaborating more on that. But you can also opt to go under self-assessment. But if you are in the business of running a professional business, you are a doctor, an accountant, a lawyer, etc., you cannot use presumptive. If you are in construction services, public entertainment, and in the business of offering utility services, you cannot use presumptive. We are going to see that under the proposals, presumptive tax may be attractive, especially if you keep records. I will elaborate on that. If you are a partnership, and a partnership being where two or more people join in trade for purposes of joint profit, then your income is taxed under rules of partnership. A partnership is treated as a vehicle to enable the partners to do business, but the person who pays the income tax is actually the partners who are taxed like any other individual. So what happens is that the partnership income is determined, shared to the partners according to the profit sharing ratio, and then individual rates are applied to determine the tax liability. If you are a trust, the tax liability falls on the trustee. But here we have to know that when it comes to unit trust, it is included in the definition of a company. So unit trusts are taxed under companies; they are not taxed under trusts. And then retirement funds like NSSF also pay tax on their income. It has been a controversial subject, and of course it touches most of us, but the law says that even if you are a retirement fund, when you have your chargeable income, it is subject to tax. And then for government, either central government, local government, and listed institutions which are listed in the first schedule Income Tax Act, those ones, they are not subject to income tax. Which rates apply to the different persons? Individuals have different rates, both for resident and non-resident. But the rates range from 10, 20, 30, 40, and they are contained in part 1 of that schedule Income Tax Act. Of course, that this is also to note that there is also zero, though I didn't include it. If you are below the threshold of 235,000 per month or 2,820,000 per annum, then you are not taxed. Your tax rate is zero. You effectively don't pay any tax. But if you earn above that, depending on the brackets which I didn't put here, you will be paying tax at those rates. The highest being 40%. For companies, the tax rate that applies is 30%. But if you are having a non-resident company or a branch of a foreign company, then that one is on the top of the 30%, it also suffers 15% if there is any repatriated income during the year. For trustees and retirement funds, they are taxed at the rate of 30%. Presumptive tax rates. Under the new proposals, which should be effective 1st July 2020, new rates have come up for presumptive tax, different from what we have been having. The previous rates have been almost in two categories: one depending on turnover, and another one depending on location and nature of business. But the proposed one is now looking at whether the taxpayer has records or without the records, and then the turnover of that taxpayer. When you look at the rates, if you have your gross turnover which does not exceed 10 million, you don't pay any tax. The only challenge you always have is, how will you know that your turnover is below 10 million because you are not filing a return? Because at times when they go to the field, they are saying to you, where is your tax payment? Where is your tax return? So how do you establish that somebody's turnover is below 10 million? Something which is still not clear. Where gross turnover exceeds 10 million but does not exceed 30%, if you don't have records, you will pay 80,000 fixed. But if you have records, you will pay 0.4% of annual taxable turnover in excess of 10 million. And when you do the math, definitely you will pay a lower rate of tax than if you don't have records, which still emphasizes that as taxpayers, we need to have our records to benefit from such. Where gross turnover exceeds 30 million but does not exceed 50 million, then the fixed rate is 200,000 or 8,000 plus 0.5% of annual turnover in excess of 30 million. Where gross turnover exceeds 50 million but does not exceed 80 million, if you don't have records, you pay 400,000. If you have records, 180 plus 0.6% of annual turnover in excess of 50 million. If the turnover exceeds 80 but not exceeding 150 million, you pay 900,000 or 360,000 plus 7% of the amount by which turnover exceeds 80 million. When we leave that, we need to know, how do we determine whether somebody is a resident or a non-resident? A non-resident will not meet the requirements of being a resident. And a resident is someone, especially if I can use an individual, I may not go into or and a company. An individual is one who has stayed in Uganda for at least 183 days during the year of income, or an average of 122 days during the year and the 2 preceding years. A person who has a permanent home in Uganda and an employee of government of Uganda deployed outside Uganda during the year of income. That becomes a resident individual. For a company, if it is incorporated or formed under laws of Uganda, its major operations are taking place in Uganda at any time during the year, or management and control is exercised in Uganda at any time during the year, then that becomes a resident company. If it is not a resident company, it is a non-resident company. Like I said, a branch is treated as a non-resident company, and as I've already alluded, If it is a branch, then it will suffer 30% on tax-adjusted profit, but also 15% on repatriated income, if any. For individuals, the rates I have indicated will apply, but for non-residents, they don't have a threshold. So from that means that any amount that is earned by a non-resident is subject to tax. Again, the implication of the residence is that if you are a resident, we tax you on worldwide income, or what we call income from all geographical sources. And if you are a non-resident, we only tax you on income from sources in Uganda. So we are not bothered whatever income you earn from somewhere else, we tax you only on income earned from Uganda. From there, I will go straight to some tax compliance issues. When it comes to business income, you can account for business income by filing returns and, of course, paying the tax that is due as indicated in your returns. When you fail to comply, then you are able to pay penalties for late filing, you are able to pay penal interest for late payment. So we need to always observe the tax calendar to know that we are not on the wrong side of the road. So the main returns that a person with business income is required to file are two: the provisional return and the final return. The final return, or what we usually call the self-assessment return, is due within 6 months, or by the end of the 6 months after the year of income has ended. And any tax that is due at that time is also payable. What do I mean? If you are using the normal year of income, which is the year ending 30th June, it means that you must file your final return by 31st of December. And any tax that would not have paid through provisional tax would be paid at that time. And that is to everybody, whether you are an individual, whether you're a company, that is the same date. But if you are an individual regarding provisional tax, you are required to file your return by the end of the 3rd month and pay the tax due within in 4 installments. We're saying that if, for example, you use the normal year of income as an individual, by end of September, 30th September, you should have filed your provisional return, and then you can pay your tax liability by end of September, end of December, end of March, and end of June. So that by the year end, you have paid all the tax due. That is what happens when you are an individual. It's a challenge that most of us, we still think that even an individual has to file a provisional tax by the end of the 6th month and pay in 2 installments. No, it is in 4 installments, and you file the return by the end of the 3rd month within the year. For a company, you file your provisional return by the end of the 6th month within the year, and you pay the tax in 2 equal installments, and that is by the end of the 6th month and by the end of the 12th month. Of course, as I said, if you don't file in time, you are going to be penalized. But also, if your provisional numbers are not correct, if you do what we call under provisioning, you're also going to be penalized at 20%. If you get your final tax liability You do 90% of that, you subtract what was provided, the difference is an under provision, and you are penalized 20% of that if your numbers are not okay. Now, I need to go to Peter, one slide back. Now, I need to highlight the new changes that have been proposed, which affect business income. I will, of course, summarize these aspects because most of the technicalities my co-presenter Veronica has already presented, so I was summarizing some of these issues which was not covered there. So we are looking at the changes that are proposed in the amendment bills that affect business income, and one of them I have already explained is that the rates for small business taxpayers have been changed, and as I said, they are illustrating the fact that we are encouraging taxpayers to keep proper records, because if you keep proper records, you are going to pay less tax. If your records are not proper, then you are going to pay a constant amount, which is a bit higher. The other change which has come, and maybe as a relief to most of us, is that there has been deferral of tax payment for tax which was due for the months of April and 30th June. If you had any tax which was payable between 1st April and 30th June of 2020, you are likely to get a relief by that amount being deferred to 30th September 2020, but on the two conditions. One, that you are involved in the business of tourism, manufacturing, horticulture, floriculture, and that your turnover is below 500 million per annum. If you are above 500 million, you are not considered small and medium taxpayer or a business, and for you, we are saying you may deal with a tax liability. But this one is meant to favor especially the SMEs. However, looking at what has happened with the COVID-19 disruptions, there is a feeling that this should have applied with every other business. Because apart from those who were dealing in essential supplies or supply of goods and services deemed essential by government, I think everybody was in the lockdown and we may have been facing the same business terrain. So, but that is what is proposed. The other issue is that if you are a person who is liable to pay tax on chargeable income, here we are talking of payee. You are in a business, you are an employer, and you are required to remit chargeable income. I mean, you are supposed to remit tax on chargeable income of your employees. Then we are saying that also for the liability which was due 1st April to 30th June, defer it until the 30th of September. That one is any person who has tax on chargeable income. It is also important to note that the government has said that during this deferral period, no penalty or interest will accrue in respect of that amount which has been deferred. So you don't have to worry that you're going to attract penalties. There will not be any penalties during that period. The next change, of course, which is quite important to us, is that there will be a waiver of interest on arrears which will be unpaid by 30th June by taxpayers who voluntarily comply. Members, when we talk about compliance, we always look at a situation where we are saying that a taxpayer is disclosing the right income, is paying their tax due in time, filing the returns in time. Or if you cannot pay your obligation, you have entered into an arrangement with the URA or tax authority that you have agreed to pay your tax liability. You are taken to be compliant. But we are saying that because of the challenges of the COVID-19 disruptions, you may not be able to pay the tax, but you have filed your returns. You are compliant in all other aspects, if I can call it. In this case, you're going to get a waiver of interest that would be unpaid by 30th June. By implication, fun as it is, it means you should have paid the principal tax, because I entered into an arrangement to pay all the principal tax for you to benefit from the waiver of the interest, because it will only be granted to taxpayers who are compliant. And also we note that during the COVID-19 time, lockdown, URA came up with some business continuity measures. Most of you must have seen them, they are on the web portal, but key among those affecting the business income is that for those taxpayers whose accounting date was 30th September and 31st October 2019, meaning that the returns were due by 31st of March, I think, and 31st April. Those returns where they were not filed, URA extended the due date to end of 31st May for those returns to have been filed, and again, no penalty will be imposed if they are filed by the new due date of 31st of May 2020. Yeah, so basically that is what I needed to share with you, participants, and I will conclude with a quote from Alfred, who said that today it takes more brains and effort to make out the income tax form than it does to make the income itself. When Veronica was taking us through the computations, the rules, this and that, we have so many things that we need to do to complete that form. And as we say, at times it is harder to complete the form the way it is required, even than making the income itself. Thank you very much for listening to me. Over to you, Veronica.
Thank you, CPA Abed, for the wonderful presentation. From the chat, I see. Thank you, CPA Abed, for the wonderful presentation. From the chat, I've noticed the participants have really enjoyed and have really learned. We are going into the question and answer session. I've seen the questions have really come in. I'll be reading out the questions, but before that, I'll request Peter to advise about the poll question. Peter, are you online? Should we proceed to the Q&A or we first do the poll question?
We can proceed to the Q&A. The poll will run as the Q&A goes on.
already learned. Thank you. We'll start with the questions that were forwarded to Veronica. Veronica, I hope you're ready. I'll read out, I think, three questions that you answer. The first question was, the first question was about corporate social responsibility costs, CSR costs. Are they allowable for tax purposes? Okay. Question number one, let me start with this one. Does the interest of 30% for earnings before interest and tax apply only for the companies in a group or for all companies? This goes to you, Veronica. Next question was, hi, Veronica, about the withholding tax on accrued interest. Is it payable to URA or it's also accrued? Next question is, what do you say about CSR costs being allowable for tax purposes? I'll add one more. If a supplier of raw materials used in production has no tin and supplies are above 5 million, does he or she only get 5 million? Over to you, Veronica. Kindly answer those. I'll also request members to answer the poll questions and submit your results. Veronica, kindly go through the questions.
Okay, thank you, Madam Chair. So the first question on whether interest applies to all companies or group companies. So the 30% restriction on EBITDA applies only for group companies. So those are companies that are related to each other. Then the second question on withholding tax on interest, whether it's payable to URA. So that one, there are two things to note. The first one is when interest is accrued, at what point is withholding tax due? And also at what point does a company get a deduction? So for accrued interest, that one, a company will get a deduction. So if it's deferred interest, so that deduction will apply when that interest is paid. But if it's non-deferred, then a company should get a deduction subject to the restriction. Then the withholding tax will apply for accrued interest once it's paid. Once interest is paid, then you can charge withholding tax. The third question is on treatment for CSR costs. CSR costs, I would classify them under donation because these are basically made by a company and it's a gift or a donation to another company or a group of company or individuals. So these costs, when we are determining whether they're allowable or not, we look at the provisions for donations. So the exemption only applies if you make CSR expenses to companies that are exempt, and those are mainly non-for-profit entities, but that entity, strictly speaking, should present an exempt certificate from URA and for that exemption to apply. And also the 5% restriction. So the donation is limited to a specific amount. Then where a company is making CSR, especially in this COVID period, there's proposal that any CSR made to government for the pandemic, either for treatment or prevention of the pandemic, then those ones should be exempt. And so those ones should be deductible for tax purposes. Otherwise, if a company doesn't have those exemptions, then they are not deductible for tax purposes. The last question was on supply of if a company receives raw materials from its supplier and that amount is more than 5 million and they don't have a TIN, yes, the company should pay the supplier. But what we are saying, for the company that's purchasing to get a deduction for that expense, the company, if you're dealing with a supplier who doesn't have a TIN, then that expense is not allowable. So the key point is to engage with suppliers who have TIN where more than 5 million is involved so that you get a deduction for expenses. Thank you. If you're dealing with a supplier who doesn't have a TIN, then that expense is not allowable. So the key point is to engage with suppliers where more than 5 million is involved so that
Thank you, Veronica. I'll move on to, there's one person, Amos Nyombi. He has quite a number and they're all directed to you. I'll read these ones, then we shall read other questions that have been directed to CPA Obed. He says, good morning, Veronica. Thank you for the presentation. My questions are, taxpayers have had challenges with records for assets to be able to claim capital deduction. Is it allowable to use revalued amounts obtained from a professional valuer for purposes of computing capital allowances? Question number 2, what record is a taxpayer required to keep in case of spoilages and damages, say for bread expiring and disposed of? What do I need to present to a URL officer to allow such a cost for expired or damaged goods? Question number 3, most taxpayers have inherited property and they are generating income from it currently, but such property and assets lack support. Kindly advise. Question number 4, individuals have generated income from banana plantations and got this income and continuously invested it in SMEs. How does one account for such additional capital from agricultural activities which actually lack receipts and yet it is invested in the SME business? Number 5, is it acceptable to use withholding tax certificates of 2017, 2018 to offset tax of 2019, 2020? Over to you, Veronica. Kindly answer these, then I'll proceed to CPA Obed.
Thank you, Chairperson. The first question is on capital deductions. What cost, if a company doesn't have a cost to use, can they use a revalued amount? If you look at the law, it talks about costs, not revalued amount when determining the capital deduction. But also we need to look at scenario in terms of if that revalued amount represents the market value of the cost of that asset. And this will happen in cases where you don't have the cost base for that asset. Then in practice, you may use that one. Though strictly speaking, if you look at the law, it looks at the cost base at the time of purchase of that asset. So where a company doesn't have that value, at least there's a market value that can be used for purposes of computing capital allowances. Then there's a question on the damaged goods or goods that have expired. So if a company has goods that have expired, the option is either to destroy them or to sell them. So for you to get a deduction for such costs, before you destruct those goods, because you write off those assets or expenses in your books. So before you destroy those assets, at least you need to notify URA that we have these assets and we are destroying them, and they witness, as well as various authorities, depending on the nature of those assets. So once you have that evidence, then it will help, it will act as evidence for you to get a deduction for such spoiled or damaged goods. The other option is for a company to dispose of those goods. So once you dispose of, the disposal may be at a specific value. So those assets, the proceeds you get, you reduce that proceed from the respective pool of such assets for capital allowance purposes. The other question is on inherited property. So someone doesn't have a value and they've just inherited the property. At least you can get the market value for such property. And for individuals where you're getting income from such property, there is rental income tax, which is computed separately. And for individuals, there's a prescribed rate of expenses. So there's a separate computation for income arriving from inherited property where a company gets rental income. There's another question on withholding tax certificates. If a company has withholding tax certificates from 2018, can they offset them in 2019? The answer is yes. The law does not limit the deductibility or the utilization of those credits, and the law allows an offset for withholding tax credits. I know we've had some pushbacks from URA in the past, and URA has been requesting companies to request for a refund instead of utilizing that brought forward credit in a subsequent year. But there is a case of Red Chili versus URA, which is a recent case where they also ruled that URA has no basis to refuse utilization of withholding tax credits. So the ruling was in favor of the taxpayer and they can utilize the withholding tax credits. Thank you.
Thank you, Veronica. I'll read out more questions that are going to CPA Abed, starting with this one from Andrew Maweje. He says, is there any possibility that national companies can accept or seek for tax increment for the development of our nation, and what are the negative side of tax increment? Another question coming in from Chemuhendo Christina says, companies, are they allowed deductions like at the end of the tax holiday, which get exhausted in a period less than the tax holiday period? I'll read this again. Companies that receive tax holiday for let's say 10 years, are they allowed tax deductions like startup costs, etc. at the end of the tax holiday, which get exhausted in a period less than the tax holiday period? Next question coming in from Vincent Onyango. Hello, thanks for the presentation. My question is about intangible assets developed internally, say software, which may have insignificant actual costs. On my evaluation for tax purposes, can my evaluation for tax purposes be their fair value? Next question from Joseph Jumba, what is the treatment for VAT paid to URA in regards to income tax purposes? A final one to you, CPA Abed. What also about payments to consultants made by companies that are not withholding agents? Is it mandatory for them to withhold? I'll request CPA Abed to answer these, then we will proceed to read out more questions since we have about 20 minutes to go.
Yeah, okay, thank you.
CPA Abed, kindly answer the questions.
Okay, thanks. I'm going to start with the first question, where we are saying, can we seek tax increment for the development of the country, and would it be better for our country? That one, the answer is not clear for one reason. Yeah, the government would want, of course, more contributions from taxpayers so that we can increase revenue, which can be able to be used to develop the infrastructure, to render any service that the government is interested in. But however, you need to know that there is a limit to which taxpayers can be taxed. Because at the end of the day, if taxpayers overtaxed, that means that will have a negative impact on the business, and which will mean that you may not have future taxpayers. As someone said, taxation involves an art of plucking the feathers from the goose with less hissing. So you really have to strike a balance. Regarding allowances, if I go to the question right, where a taxpayer has tax holiday, let's say 10 years, those allowances cannot be carried forward beyond that 10 years, if I can say. What I'm trying to say is, you will continue computing the allowances, especially capital allowances, the normal way. And when the exemption ends, you carry forward those written down values of the assets as at that time, and then that is what you will get. So you cannot accumulate the capital allowances, which you were accruing in the time when you were enjoying a holiday, because actually there was no tax to pay, there was no chargeable income to offset those capital allowances. So the only thing for assets, you keep on computing wear and tear, keeping the written down values, and when you go back, when the holiday ends, you pick those written down values, carry forward, and enjoy the capital allowances which are still remaining at that time. Then there is an issue of intangible assets. For intangible assets, the law says that you can only claim a deduction where that intangible asset has a useful life. And of course, you must have incurred the cost that you are going to claim. So the main challenge we have is, especially internally generated intangible assets. What is the useful life of that asset you have generated? Because the law says that for an allowance in regard of intangible asset, you get the cost over the useful life. So where you can exactly attribute the cost incurred in building that intangible asset, and you can ascertain the useful life, then that addition you are talking about can be capitalized and you enjoy the respective allowance. The challenge is that in practice, most intangible assets, it is hard to get the cost equivalent to its value, but it is also hard to get the actual useful life. Regarding VAT paid to URA, possibly the question was not so clear, but if I can contextualize. When we are reporting transactions for accounting purposes, we report them net of VAT. What I'm trying to say is that if they are sales, you record sales net of VAT, amount exclusive of VAT is what is booked as sales or income. If you are recording an asset or an expense still where you are VAT registered and you are claiming the input VAT, then still that does not become part of the cost base of the asset, neither the expense, because you are taking credit of that. So if you VAT registered, you use amount exclusive of VAT. If you are not VAT registered and you cannot recover VAT, that one becomes part of your cost base of the assets and part of your expenditure. So you claim the total invoice amount in your computing the allowable deductions. Also, there are cases when you claim input VAT credit, but when URA comes to audit, they say, no, we are not allowing you this credit. And in that case, you also can use that as an allowable deduction if URA has disallowed that input VAT credit, because in that case, you can't lose twice. Since they have not given you the credit for input VAT, it becomes an expense for income tax purposes. The other issue was about payments to consultants and in respect of withholding tax. The law says that a resident person who pays professional or management fees to another resident person should withhold at 6%. So the condition here is you are a resident person, a resident taxpayer, you are paying professional or management fees to another resident person. The question which comes is, what are management fees? What are professional fees? Professional fees, there is a practice note by URA which tried to highlight what professional fees are. And the approach used is like the payments to the traditional professionals or members of the traditional professions, engineers, accountants, etc. And when you look at the management fees, that one, the definition is not clear, especially when you go to international taxation, this is where they define management charge as any cost that is paid for services rendered apart from employment services, whatever way they are calculated. So it is a bit broad. But in essence, we are saying that if you have paid what somebody has charged as a management fee or professional fee, and that person who has given you an invoice is not exempt from withholding tax, you, the payer, you are obliged to withhold 6%, irrespective of the threshold. The threshold in this case does not apply. You don't have to say it must be above 1 million. No, it is any payment or management of professional fees by a resident person, another resident person. Over to you, moderator. Moderator, are you getting me?
Thank you, CPA Obed. I'll read out more questions. Some of these have been sent directly to Veronica. Question number 1 is, you talked about deadlines for submissions. Is there any extension? Another question is, I did not get properly donations by companies to government during this COVID-19. Another question is to you, Veronica, is e-invoicing mandatory to everyone? Lastly, from Vincent Sonko to you, Veronica, the raising and assessing taxpayers for financing their businesses using money contributed by members, probably in case of non-Ugandan, brings in money from abroad on a mutual agreement. Then URA makes assessment on that money, calling it undeclared sales, which is not right. How can I object to such? How can I object to such, and what documentary evidence should I present? Veronica, kindly answer those.
Thank you, Madam Chairperson. The first question is on the deadline for submission. And I'm thinking they are talking about the withholding tax exemption as well as the withholding VAT. So the deadline given was 25th May, but okay, URA has not provided any exemption for now, but we hope it will be there, or it's good to reach out to them and see if there's a window for that, seeing as it's a new automation, so that everyone gets the same chance to apply for the exemption. So the answer is right now, the deadline remains the same. So the donations to government, what the proposal sets out is that donations that companies are making to government to enable government treat or to enable government to fight the pandemic for COVID-19. So such donations which are made to government by entities, that should be an allowable expense for a company. Then the registration for e-invoicing, right now, all companies are required to register for e-invoicing. And especially for companies that want to be included on the withholding tax exemption list, because one of the requirements for inclusion on the withholding tax exemption list is to at least show that the entity is registered for e-invoicing. However, URA will issue a designated list for companies that are required to operationalize and implement that later as from 1st July. The question on undeclared sales, why URA is saying that a company has undeclared sales, and so they should account for VAT and as well as income tax on that. So you have to look at, from the question, the basis is because that is not a sale and that income relates to some form of investment. So if it's a sale, you need to show to URA or evidence to confirm that there is no sale that was made, and at least you need to have some form of invoices for the different sales which are made. Otherwise, it shouldn't be part of, it shouldn't be adjusted for income tax purposes. Thank you.
Thank you, Veronica. Because of time, I'm going to read one last question that I'll direct to CPA Abed, and I'll hand over to Mr. Ahumuza from ICPAU to close the session. I'll read one question to you, CPA Abed. This one is coming in from Julius Chigundu. He says, is it a requirement to apply for withholding tax exemption when you're listed in the Income Tax Act as an exempt taxpayer? Example is financial services sector whose interest income, fees and commissions are withholding tax exempt. I'll give you just one more. from Musinguzi Charles. He says, how long, I missed out a word, withholding tax deducted can be carried forward if assessed. I failed to read this, it's a bit unclear. Let me read the last one. What are the requirements of recognizing bad debts as a deductible item when deriving taxable income? I'll request CPA Abed to answer this, then I'll hand over to Mr. Ahumuza. But I'm also hoping that you've answered the poll question, since the questions asked about getting information that will be used for our own benefit. And also continue sending in your questions. As told, they will be answered. Mr. Ahumuza will advise about that. CPA Abed, kindly answer those, then I'll hand over.
Thank you. I'll start with the issue of withholding tax exemption. For you to apply for withholding tax exemption, you're trying to say, when I make surprise to my customers, I don't need them to withhold such that it improves your cash flows. So in this case, if you have exempt income, or if your income is exempt, it does not suffer withholding tax, because withholding tax is advance tax. I'm trying to say that if you are exempt by law, any person paying you will not be obliged to withhold. But we have to appreciate that when it comes to something like interest, when you go to the exempt income, the law says that property income is not enjoying that exemption, apart from rental income that is used to further the activities of that entity. So in short, it is saying that if you have interest income, for example, from treasury bills, from fixed deposit account, that income still suffers withholding tax, because the exemption under section 21 does not cover that income. Then possibly the other question, which was not clear, if I can contextualize it, the gentleman, I think, was saying, if you have claimed withholding tax, for how long do you carry forward the credit? And in this case, there is no limit to how long you can carry forward the credit, because the requirement is once you have disclosed it to your, once you've claimed it, you keep offsetting it from any arising tax liability, and there is no time limit. The only time limit, I think, which is there, I'm not remembering the exact period, possibly it could be 5 years, I am not very sure, is that if you have not claimed it, you may not claim it after a certain period. I'm not so sure of the period. But once you've claimed it, you keep carrying it forward indefinitely, almost the same way we carry forward losses indefinitely, despite the fact that government has been trying to put a limit to that. But for tax credit, that limit is not even contemplated. The last one, requirements, I think I missed the last one. Moderator, you can remind me about the last one? Hello? Hello? Are you getting me, moderator? You can remind me the last question.
Okay, CPA Abed.
Yes.
The last one was, what are the requirements for recognizing bad debts as a deductible item when deriving taxable income?
Okay, thank you. So the law says that where you incur a bad debt, it is an allowable deduction, provided you meet some conditions. The conditions are that that bad debt must have arisen from a business transaction. It must have been included in the gross income for any year of income. So if it was not included in the gross income for any year of income, it cannot be an allowable deduction. The second one is that you must have taken all reasonable steps to recover the debt, and you believe you are not able to recover that debt. That means that there should be evidence of follow-up on that data. For example, sending reminders, engaging with lawyers, engaging with debt collectors. You must have proactively taken steps to recover, and you have failed to recover. And for financial institutions, which basically here it includes those regulated by Bank of Uganda, that condition of taking reasonable steps is a bit waived, because the law says that if you have made any specific provision for bad debts in line with BOU regulations, then that amount would be allowable if you are a financial institution. Basically, those are the requirements. Over to you, moderator.
Thank you, CPA Abed. Your presentation was really informative. As I hand over, I'm going to thank the Institute of Certified Public Accountants for organizing this webinar. I believe all of us have picked something. I myself have learned a lot. Thank you for thinking about us in this COVID period and making sure we get the professional development that to get. Right at this moment, I'm going to hand over to CPA. I say thank you for attending. Participants that have attended today have been over 750, which is a good number. Continue spreading the word. Tell other CPAs not to miss out on these webinars because they're really informative. Thank you so much. Thank you for listening in. Over to you, CPA Ambrose and Mr. Ahumuza.
Chair, we have Council Member CPA Ruth Doreen Mutevi. She will be closing the session. Over to you, Ruth.
All right. Thank you so much, Peter. Good afternoon, members. Thank you so much, our panelists, CPA Abed and CPA Veronica, for sharing unreservedly insights that are very, very useful to us at this point in time. I'd also like to thank Secretariat for organizing the webinar. We appreciate it's become a practice, and we're expectant every Friday to have these webinars run. To each of the members, my kind ask to you is let's take the lessons from the webinar and from our engagements that we've been having to support our institutions to be tax compliant, but to also support everyone out there. As members of ICPAU, we should be, and we are partners with URA to enhance tax compliance for the benefit of our institutions, but also for the benefit of our country. Thank you so much. I wish you a very good afternoon. Over to you, Peter.
Thank you very much. Thank you very much. We have come to the end of the webinar. Thank Thank you for attending. We'll be hoping to see you tomorrow for the voters education webinar. Have a good afternoon.